Picture this. You just sold your late husband's truck for $14,000 cash. The buyer handed you an envelope, you counted every bill, and now you are sitting at your kitchen table staring at more cash than you have held in your hands in years. You want to put it in the bank. That is the responsible thing to do. But then your neighbor tells you something. She says, don't deposit all of that at once. If you put more than $10,000 in the bank, the IRS is going to come knocking on your door. So you think about it. And you decide to play it safe. You go to the bank on Monday and deposit $4,500. Then on Wednesday, you deposit another $4,500. And on Friday, you go back and deposit the remaining $5,000. You feel smart. You feel like you just protected yourself. But what you actually just did, without knowing it, is commit a federal crime. And the penalty can be up to $250,000 in fines, up to 5 years in prison. And the government can seize the money you deposited, even though every single dollar was earned legally. I know that sounds unbelievable, but it is true. And it is happening to retirees across this country right now. My name is Edward. I am a senior policy analyst and retirement finance researcher. And here on Wisely USA, I break down complicated government rules into plain English so that you can protect your money, your benefits, and your peace of mind. Today, I am going to explain the exact federal banking rule that is tripping up thousands of retirees. I am going to show you what the law actually says. I am going to walk you through the 5 traps that catch people off guard. And I am going to give you 3 clear steps you can take today to make sure you never accidentally break this rule. But please stay with me until the very end, because there is one mistake, one very common, very innocent-sounding mistake that a surprising number of retirees are making right now. And most of them have no idea it could cost them everything. If this is your first time here on this channel, go ahead and subscribe right now and tap that bell icon. We cover every rule change that affects your Social Security, your banking, your Medicare, your taxes, and your retirement income. And this is one video you absolutely need to hear. Now let me tell you a story, because this story will change how you think about your bank account. Harold is 71 years old. He retired 6 years ago from a small construction company he ran for 35 years. He gets Social Security, he has a modest pension, and he lives in a paid-off house in Tennessee with his wife, Carol. Last spring, Harold and Carol decided to sell their second vehicle. They found a buyer through a friend at church. The buyer paid $16,000 in cash. Harold drove straight to the bank. But when he got to the teller window and started counting out the bills, the teller said something that stopped him cold. She said, "Mr. Henderson, you know if I take this deposit, we are required to report it to the government." Harold did not like the sound of that. He asked her, "What do you mean, report it?" She said that any cash deposit over $10,000 triggers a federal report. She said it was called a currency transaction report. Harold panicked. He thought the IRS was going to audit him. He thought the government was going to think he was doing something illegal. So he told the teller, "Just take $8,000 for now." He went back a few days later and deposited the rest. Harold did not tell anyone what he had done. He thought he was being careful. 3 months later, Harold got a letter. Not from his bank, from the federal government. The letter said his bank had filed a suspicious activity report, and an investigation had been opened into Harold's deposit pattern. Now, Harold's money was completely legal. It came from selling a truck. He had the title, he had the bill of sale. There was nothing wrong with the money itself. But the way Harold deposited it, breaking it into smaller amounts to avoid the reporting threshold, is exactly what federal law defines as structuring. And structuring is a federal crime under 31 U.S.C. 5324. Harold ended up hiring a lawyer. It cost him over $8,000 in legal fees just to resolve the situation. He was fortunate. He was not prosecuted. but the stress nearly broke him. Carol told me she had never seen her husband so scared in his life. And the cruel irony? If Harold had just walked in and deposited the full $16,000 in one transaction, nothing would have happened. The bank would have filed a simple CTR. Nobody would have called him. Nobody would have investigated him. It would have been completely routine. Harold's mistake was trying to avoid a report that would have caused him zero problems. And that is the trap that catches retirees every single day. So let me explain this rule to you clearly. No legal jargon, no confusion, just the facts. Under a federal law called the Bank Secrecy Act, every bank and credit union in the United States is required to file a currency transaction report, called a CTR, whenever a customer makes a cash transaction over $10,000 in a single day. This includes deposits, withdrawals, exchanges, or any other cash movement that crosses that $10,000 threshold. If you deposit $12,000 in cash, the bank files a CTR. If you withdraw $15,000, the bank files a CTR. If you make multiple cash deposits at the same bank on the same day that add up to more than $10,000, the bank files a CTR. Now here is the part that most people get wrong. This report is not a red flag. It is not a warning. It is not the beginning of an investigation. It is a routine informational filing that goes to a federal agency called FinCEN, the Financial Crimes Enforcement Network. Banks file millions of these reports every single year. FinCEN's own pamphlet, the one they issue to bank customers, says this, and I am going to quote it directly. It says, "There is no general prohibition against handling large amounts of currency, and the filing of a CTR is required regardless of the reasons for the currency transaction." Let me say that again. There is no prohibition against large cash transactions. The CTR is filed regardless of the reason. If your money is legal, you have nothing to worry about. But here is where the law gets serious. What is illegal under 31 U.S.C. 5324 is something called structuring. Structuring is when you deliberately break up a large cash transaction into smaller amounts for the purpose of avoiding the CTR report. That is exactly what Harold did. He had $16,000 in cash. Instead of depositing it all at once, he broke it into two smaller deposits, one for $8,000 and one for $8,000, specifically because he wanted to stay under the $10,000 reporting threshold. The moment he did that with the intent to avoid the report, he broke the law. And here's the part that shocks most people. The law says, and I want you to really hear this, structuring is illegal regardless of whether the funds are derived from legal or illegal activity. That is a direct quote from the IRS Internal Revenue Manual. It does not matter if the cash came from selling your home. It does not matter if it was an inheritance from your mother. It does not matter if you saved it in a coffee can for 30 years. If you deliberately break it up to avoid the bank filing a report, you are structuring. And structuring is a federal crime. Now let me walk you through the 5 traps that catch retirees, because once you understand these, you will never make this mistake. Trap number 1, you think depositing cash in smaller amounts keeps you out of trouble. This is the most dangerous belief out there. Breaking a $15,000 cash deposit into 3 deposits of $5,000 does not protect you. It does the opposite. It creates the exact pattern that banks are trained to recognize. When a bank sees multiple deposits just below $10,000 from the same customer over a short period of time, they do not ignore it. They escalate it. They file a suspicious activity report. And that SAR goes straight to federal investigators. So the very thing you are doing to avoid attention is the thing that attracts the most attention. Trap number 2. You think a CTR means you will be audited. This is simply not true. A CTR is not an audit trigger. It is not a red flag. It is a form the bank fills out and sends to FinCEN. You do not even need to do anything. The bank handles it. You walk in, make your deposit, and go home. The CTR is filed behind the scenes, and in the vast majority of cases, nothing else happens. But if you try to avoid the CTR by breaking up your deposits, that is when something happens. Because now, the bank may file a SAR instead, and a SAR absolutely can trigger an investigation. Trap number 3. Your bank teller tells you to split the deposit. This happens more often than you would think. A well-meaning bank employee might say something like, you could come back tomorrow with the rest to avoid the paperwork. Or maybe you want to keep this one under 10,000. Do not listen to that advice. Even if the teller means well, that suggestion is pointing you directly toward a federal crime. And under the law, if a bank employee assists or guides a customer in structuring transactions, both the employee and the customer can be held liable. The IRS Internal Revenue Manual specifically identifies this scenario. Bank employees collaborating with customers to structure deposits. It does not excuse you. If you follow that advice, you are still the one who made the structured deposit. You are still the one facing the penalty. Trap number 4. You sell something for cash and assume you do not have to report anything. Here is a common scenario. You sell your old car for $12,000 in cash. The buyer pays you in $100 bills. You are not a car dealer. You are not in a trade or business, so you do not need to file a Form 8300. That part is true. But when you take that $12,000 in cash to your bank and try to deposit it in 2 separate visits, $6,000 on Monday and $6,000 on Thursday, you have just structured a deposit. The sale was legal, the cash was legal, but the way you deposited it was not. Just walk into your bank and deposit the full amount. If the teller asks where the money came from, just tell them you sold a vehicle. That is all you need to do. Trap number 5. You think the $10,000 rule only applies to deposits. It does not. The currency transaction report requirement covers all cash transactions. Deposits, yes, but also withdrawals, also currency exchanges, also purchases of cashier's checks and money orders. So if you walk into your bank and withdraw $12,000 in cash for a home repair project, the bank files a CTR. That is normal. That is fine. But if you try to avoid that report by withdrawing $9,000 today and $9,000 tomorrow, you are structuring a withdrawal. And that is just as illegal as structuring a deposit. The law does not care which direction the cash is moving. If you break up any cash transaction to stay under $10,000 for the purpose of avoiding the report, you are in violation. Now, I know this sounds frightening, so let me tell you about the protections you have, because the law also protects honest people. The single most important thing for you to understand is this. If your money is legal, you have nothing to fear from a CTR. FinCEN has explicitly told banks to inform customers that a CTR is filed regardless of the reason for the cash transaction, and that there is no prohibition against handling large amounts of currency. A CTR does not affect your credit. It does not affect your Social Security. It does not trigger an audit. It does not get you in trouble. It is paperwork. That is all. Your financial privacy is also protected. FinCEN's own reference guide states that banks collect your information for the CTR in a manner consistent with your right to financial privacy. The information on the CTR cannot be used for purposes unrelated to legal compliance. There is also a separate protection that many people do not know about. If a business files a Form 8300 about you, for example, if a car dealer reports that you paid more than $10,000 in cash for a vehicle, that business is required by law to send you a written notice by January 31st of the following year. That notice must tell you the form was filed and that the information was reported to the IRS. You have a right to know. And if you ever feel that a bank is treating you unfairly, pressuring you, giving you bad advice, or handling your account in a way that does not seem right, you have the right to file a complaint with the Consumer Financial Protection Bureau. The CFPB has a dedicated office for older Americans that specifically works to protect people aged 62 and older from financial exploitation and unfair banking practices. Now, let me give you your 3 action steps. These are simple, they are clear, and they can protect you from ever falling into this trap. Step number 1, if you have a large amount of cash, deposit it all at once. Do not break it up. Do not spread it across multiple days. Do not go to different branches or different banks. Just walk in and make one deposit. If the teller asks for your identification or asks about the source of the funds, answer honestly. You sold a car. You received an inheritance. You cashed out a savings bond. Whatever the truth is, just say it. The bank will file a CTR. You will go home, and nothing bad will happen. The only scenario where something bad happens is when you try to avoid the report. So do not avoid it. There is nothing to avoid. Step number 2, never take advice to split your deposits. Not from a bank teller, not from your neighbor, not from your brother-in-law, not from anyone. If anyone tells you to break up a large cash deposit into smaller amounts to avoid reporting, that person is, whether they know it or not, advising you to commit a federal crime. Politely thank them for their concern and then do the opposite. Deposit the full amount. If you are unsure about anything, call your bank's main customer service line before going in. Ask them what you need to bring and what the process looks like for a large cash deposit. They will walk you through it. It is a perfectly normal transaction. Step number 3, keep documentation of where your cash came from. This is smart practice for anyone who handles large amounts of cash. Keep a copy of the bill of sale if you sold a vehicle or personal property. Keep a letter from the estate attorney if you received an inheritance. Keep a receipt from the bank if you made a withdrawal from another account. You probably will never need these documents. But if there is ever a question about the source of your funds, having a paper trail makes everything simple and clean. It protects you. It gives you peace of mind, and it shows that you are a responsible person who has nothing to hide. Let me recap the key numbers one more time because I want them to stick. Depositing or withdrawing more than $10,000 in cash is legal. The bank files a CTR. It is routine. You have nothing to worry about. Structuring, deliberately breaking up transactions to stay below $10,000 is a federal crime under 31 U.S.C. 5324. The civil penalty for structuring can be up to the total amount of cash involved in the structured transactions. If you structured $30,000 in deposits, the penalty could be $30,000. The criminal penalty is up to 5 years in prison and up to $250,000 in fines. If the structuring involves more than $100,000 in a 12-month period, the penalties double, up to 10 years in prison, up to $500,000 in fines. And the government has the power to seize the cash itself, even if every dollar came from a legal source. These are not theoretical penalties. They are real, and they are being enforced. Now, before I close, there is one more thing I want to mention, because it is coming fast, and it will affect many of you. If a business, like a car dealer, a jeweler, a contractor, or a landlord, receives more than $10,000 in cash from you, they are required to file IRS Form 8300 within 15 days. And they must send you a written notice by January 31st of the following year, telling you they reported your transaction to the IRS. If you are a retiree who pays for large purchases in cash, home repairs, a new vehicle, furniture, you should expect that the business will report you. This is not a problem. This is the law working as it should, but it means you need to keep your records clean and your documentation organized. Know where your money came from. Keep your receipts. And do not be surprised if you receive a Form 8300 notice in January. Now I need to ask you for something. If you found this video helpful, please hit the like button right now. That one action tells the algorithm to push this video out to more people who need to see it. And right now, There are retirees sitting at their kitchen tables with envelopes full of cash, about to make the exact same mistake Harold made. Your like could put this video in front of them before they walk into that bank. If you know any retiree who deals in cash, a friend, a parent, a spouse, a sibling, please share this video with them today. Send them the link, call them on the phone, tell them about the structuring rule. You might be the only person who warns them. And subscribe to Senior Radar if you have not already. Tap the bell icon so you are notified every time I release a new video. We cover every rule change that affects your retirement, Social Security updates, banking regulations, tax law changes, Medicare adjustments, and more. But here is the truth. YouTube does not always show you my videos. The algorithm decides what you see, and you could miss the next critical update that directly affects your finances. That is why I created something specifically for our community. Click the link in the description below this video to join the Global Senior Alerts official WhatsApp channel. When you join, you will be able to download a free Senior Benefits Protection Guide. This guide covers everything we talked about today: the CTR rule, the structuring law, your rights, your action steps, all in one document in plain English that you can keep and reference anytime. You will also receive real-time alerts whenever there is a new change to Social Security rules, banking regulations, tax laws, Medicare policies, or any other rule that affects retirees and seniors. No spam, no selling, just the information you need delivered to your phone the moment it matters. Remember, depositing your money is not the problem. Trying to hide your deposit is the problem. If your money is legal, deposit it all at once. Let the bank file the report, keep your records, and go home knowing you did everything right. I am Edward, and this is Senior Radar. I will see you in the very next video. Stay informed, stay protected, and take care of your money.